Hello friends, welcome back to the channel again. So today we will be discussing on the basics of mutual funds. Let us start a series on mutual fund. So today we'll be discussing on the basics of mutual funds. Very at the basic level we'll discuss, and then on the later part of the series we'll discuss in detail about the all the mutual funds industry, how it works, and what are the mutual funds available to invest. We'll discuss in detail. So for today's uh, session we'll discuss the basics of mutual fund. Okay, so if you are a beginner or someone confused about mutual funds, by the end of this video you will be able to understand what are the mutual funds, or what type of mutual funds are there in the industry, in the market, and you will have a complete clarity on the mutual funds. Okay, and we will cover today what is mutual fund, and types of mutual funds, how they work, how fund managers operate, real-time examples with facts and figures, how to invest in mutual fund, and risk and benefits. So risk and rewards we'll discuss. So stay with us till the end of this video, and don't forget to subscribe if you find this helpful. Okay, so let us start with the very basic thing. So what is mutual fund? So here, like, a mutual fund is an investment vehicle where money from multiple investors is pooled together and managed by professional fund managers. Is collectively, like, money will be collected from different group of peoples or individual peoples, and that will be managed by the professional fund managers. So that is something like, as you know, investment vehicle where money from multiple investors is pulled together and managed by professional fund managers. And the fund manager invests this money in different assets like stocks, bonds, gold, and other securities. Similar, like, if individual, I am collecting money, and or for my personally, if I am investing my money into stocks or bonds, gold, and other securities. Similar way, mutual fund managers, they will collect the money, they will uh, uh, pull the money from the investors, from different investors, individuals, and they will invest in stocks, bonds, gold, and other securities as such. Okay, so example, like, imagine you and your friends contribute 1000 each, and a professional invest it wisely. This is how mutual fund works, right? So 1000 each you contributed and given it to expert. So 10 friends have contributed 1000 each, and they given 10,000 rupees to the professional fund manager or professional expert, subject matter expert, and he will use that 10,000, and he will invest that 10,000 in different sectors, different funds. So that is how it's the fund managers works, and that is how the mutual fund works. So key plays in mutual funds are, as of now in current market, like asset management company, that is generally we call them as a AMC, asset management company, and the company that manages mutual funds, like example, SBI mutual fund, HDFC mutual fund, ICICI Prudential mutual fund. So there are many such AMCs, asset management companies, are there in the market, like SBI, HDFC, ICICI Prudential mutual fund. They operate as a mutual fund company, asset management company, and they invest in this different stocks and bonds, gold, uh, as well as the securities. So now, fund managers, like the fund, who is the fund manager? Like the person responsible for making investment decisions. So suppose, take example for SBI mutual fund. So SBI mutual fund, they will be appointing one person, one expert person, subject matter expert, who will be having thorough knowledge of the mutual funds, and he will be taking investment for that fund, particular fund. The person responsible for making investment decisions is called as a fund manager. Example, like now Prashant Jain is the I think he's the ex HDFC mutual fund manager, and for ICICI Prudential, yes, Naren is the fund manager. Even for Mirai Asset, Nilesh Surana is the fund manager. So like that, uh, the fund managers will be appointed by the AMCs, and they will be taking the decision in that particular fund where to invest and under which sectors the fund should be allocated and investment, everything they will decide. So that is called as a fund managers. Now we'll see what are the types of mutual funds. So mutual funds are categorized based on their structure, asset class, and objective. So based on the structure, if we see the mutual funds, that is, first one is open-ended funds. So what is open-ended fund means? You can invest or withdraw anytime. So like example, now HDFC Flexi Cap Fund is there. So if you see close-ended funds like locked for a specific period, example SBI tax advantage funds, like if you see the ELSS funds, like that for tax saver, they will be having a lock-in period. So once you invest, you cannot withdraw that immediately. There will be 3 years or 5 years, 6 years, depending on that particular fund. There will be a lock-in period, that is called as close-ended funds, wherein in case of open-ended funds, you can invest or withdraw anytime. So that is the difference between open-ended funds and closed-ended funds. These are the based on the structure we are talking about. So when it comes to the based on asset class, uh, we need to bifurcate the mutual funds. In that case, asset class, in that case, first one is equity mutual fund, right? When it comes to the equity fund, in that high risk high return, or we can call as high risk high reward. So invest in stocks ideal for long term investors. Examples like Nippon India Growth Fund, that Nippon India Growth Fund has given 19% CAGR, that compounded annual growth, in the last 10 years. So this is the asset class. This is the equity asset class, equity mutual fund, which will be having a high risk, high reward, and specifically such class, like such equity mutual funds, they will majorly invest in this stocks, and which will be ideal for long-term investors. Second one comes as a debt mutual fund. So debt mutual fund will be always will be having a low risk and moderate return, and such funds invest in government and corporate bonds. Currently example is HDFC stock term debt fund, gives almost 6 to 8 percent return per year. Then third one is hybrid mutual funds, or we can say balanced funds, right? So in that, invest in both equity and debt for balanced risk. So I think, for example, for this is ICICI Balanced Advantage fund, that is well-known fund actually, with 12 to 14% CAGR, compounded annual growth. And this is the good ICICI Balanced Advantage fund in this category, like hybrid mutual fund, or we can call as balanced fund. Then one more important is gold mutual funds. Like gold mutual funds, specifically they invest in gold related asset. Like example is SBI Gold Fund, has returned almost 15% CAGR in 5 years, last 5 years, that is compounded annual growth, CAGR. So gold mutual funds, if you see the last, now currently the market has crashed, and everyone is scared about investing in stock market. It's always happens whenever there is a decrease in the stock market, when there is a red flag in the stock market, equity market, people starts investing in gold. So in that case, gold is always good to have that investment in such gold related assets. So even there are mutual funds like SBI Gold Fund, which is good for investment. If you wanted to invest in gold, you can directly buy such gold investment, sorry, the gold mutual funds, and via that you can keep your investment, instead of going to equity when there is a market get crash. During such time, we observe that people invest in this gold mutual funds, and the example is SBI Gold Fund, and which is like rate of return is almost 15% CAGR. This is good. So now third category is based on the investment goals. Like investment in this category, tax saving fund, that is called as ELSS. Like this is tax saver, actually save tax under section 80C. Example is Axis long term equity fund is there, HDFC ALSS fund is there. So similar way there are index funds also, like index fund, if you see low cost funds that track Nifty 50 or Sensex. Currently in that category we have UTI Nifty 50 index fund, SBI Nifty 50 index fund. There are many such index funds are there. So these are the based on the investment goals. So now we'll see how this mutual fund works. Right, now first one is investor deposits money. So you invest in a mutual fund through lump sum or SIP. Again, lump sum means one shot. In a lump sum you will invest, suppose 10 lakh one shot we invested in some index fund or some equity fund, okay, right, or gold funds. And instead of doing another categories like SIP, so month on month, monthly 10,000 you will invest in that particular fund. So that is SIP, that is systematic investment plan. So these are the two types, like investor deposits money. Then second one is fund manager allocates the money. So allocates the money means buy stocks or bonds based on the fund's objective. Then third one is NAV calculation. NAV is nothing but net asset value, that is updated daily. So based on the fluctuations in the market, based on the stock price, particular securities price, based on that the NAV will be calculated, that is net asset value, and that will be done on the daily basis. And fourth one is returns accumulate. So your money grows based on the market performance. So this is how the mutual fund works. First you invest in the mutual, means you deposit the money, then fund managers allocates that money to different stock, bonds, right? And third one is then NAV get calculated, net asset value, and then fourth is return accumulate. So in long run money grows, and you will see that in the long term the market, and which is linked to the market performance. Like example, if you had invested say 1 lakh in HDFC top 100 fund in 2010, so today it would be worth rupees 6.5 lakhs. So this is the beauty of compounding. We need to wait mutual fund industry where you can make crores rupees, but for that, in order to get that, we need the patience, most importantly, and the time period, right? The more you keep invested, the more patience you have, definitely you will generate a good wealth in the long run. Now we'll see the SIP. I spoke right, SIP and lump sum. So what is SIP? SIP is nothing but systematic investment plan. So invest a fixed amount every month. Suppose example 5,000 SIP in Mirai Asset Emerging Blue Chip Fund. So since 2015 it would be 17 lakh today. So continuous investing, consistency makes a difference actually. So systematic investment plans, consistently if you invest particular X amount, say 5,000 in particular mutual fund for 10 years or 15 years, you will see a massive wealth generated in that particular fund, based on, because the CAGR, what the then only you can see the beauty of compounding. And in case of lump sum investing, a big amount at once works best when the market is low. So people always ask you which is the good practice or good the mode, SIP, systematic investment plan, month on month is the best, or the lump sum. So always SIP is best, but some lump sum will be best only in case when there is a market crash, right? Now we see almost since 5-6 months market is giving negative return. So this is the good time. Whenever there is a fear in the market, that is the good time to invest lump sum. If you have a extra money or idle money, you can put that extra money, lump sum money, and buy the more units from this crashed market, from the the market is giving return, negative return. So definitely you will be getting a units at the lower price, because you are buying the units at the discounted rate, not at the premium. When always generally the people will buy the mutual fund units when there is a market is at the bull run, market is at the uptrend. So month on month we will keep accumulating the units at the premium price. Suppose today if I bought at 15 rupees, next month I might end buying that at the 18 rupees or 19 rupees or 20 rupees. So that is premium I have give. 15 rupees is my first one, second one is 20 rupees, so 5 rupees I premium I gave. But at the same time, if the market is down, market has crashed, that 15 rupees unit I might get at the 10 rupees, even at 8 rupees or 5 rupees. So that is called as discounted rate. So always good that if you have a good lump sum money, you can put that lump sum money only in case when there is a market at the downtrend or market crash, something like that, when like corona has happened. During such time, right? So during such time when there is a bad news in the market has 15-20% down, in that case definitely we can go ahead with the lump sum investment. So now we discussed that which is better, like SIP or the lump sum. Now we'll see how to invest in mutual fund. So there are now, if you see, there are different mutual fund, there are different brokers, and for that we need to choose first mutual fund, which mutual fund we need to invest, then complete your KYC like PAN, Aadhaar card, bank details, and invest through platforms like now Zerodha is there, Grow is there, Paytm is there, even PhonePe is now started now, AMC websites like SBI, HDFC, ICICI. There are many now. This has become very flexible to invest in a click of button. Within 5-10 minutes you can open your account and we can start investing online within a click of button. So that is nothing big deal, investment in mutual funds. And risk and returns, if you see, the risk factor in mutual funds is like market fluctuations, as we discussed. When there is a market crash, when there is a downtrend, definitely you will see the negative returns as well. That is not a surprise. Market fluctuations, then interest rate changes, then credit risk for debt funds, and ways to reduce the risk, how to reduce that risk. So in order to reduce that risk, we can diversify or invest for investment, we can do for long term, or choose funds based on the risk appetite. So based on our risk appetite we can choose the funds, and accordingly we can invest, or we can go for the long term. So when always remember, there will be the downtrend is always temporary, but uptrend, like growth, is permanent, what you call as, right? The downtrend is temporary and growth is permanent. So economy will keep growing, people will start keep consuming. So the downtrend or downfall will be a temporary, like corona, 2008 crash, like that. So those cases, such emergencies will be very for temporary period. But the growth, when Nifty 50 started at the 100 point, and now we can see, right, where it has reached. So that is the beauty of compounding. For the long term, you can see definitely the growth. So that is the ways we can reduce the risk, diversify, or go for long term investment, or choose the fund based on your risk appetite. Now the real life the investment scenarios, will see the if example, suppose you started 10,000 SIP in Nifty 50 index fund in say 2013. So today it is that 10,000 invested SIP in an index fund. Now today in 2025, that worth is, for that 10,000 worth is now 32 lakh rupees. That SIP what they made in 2013, the today's value of that SIP, 10,000 SIP started in 2013, is at 32 lakh rupees. Or when other side is like investment in mutual fund, but you withdraw during the market crash, right? If 2013 you invested, and in between the whenever there is a bad news, or whenever there is a dip in the market and you withdraw the money, definitely you will see the return, or the lump sum money, whatever you are getting at the end whenever you try to withdraw. Definitely will see the drastically the amount has came down. your expected return has came down. So what is the lesson is that stay invested for the long term and don't panic during the market crashes. So that is the mantra for here for getting the good amount of return, good amount of money from the mutual fund investment. And finally, the what is the conclusion or action plan, if you wanted to know that, like, mutual funds are a great wealth building tool if used correctly. Okay. And best practice for beginners is start SIP early as when you start the SIP, uh, systematic investment plan, month on month. If you do that, the beauty will be in the long run. When so that is the reason, start early and then stay invested at least for the 10 plus years, or minimum 5 years is must, to see the the lump sum return or the good return from the mutual funds. And choose funds based on your goals or your risk appetite. And if you invest lately and try to achieve your goal, definitely it won't be possible, because within a short term it won't possible, because there will be more volatility in the market. And to capture that CAGR, or to see that good CAGR in your portfolio, definitely you need to be keep invested in the market for at least 5 years, or you know 10 years periods, which is advisable. Okay, so this is the I think I have given a broader view of mutual funds and basics of mutual funds. In detail, we'll discuss a particular mutual funds, who are the fund managers, how they perform, what is their past history, what is their CAGR, right? So in detail we'll understand in our next videos. But for now, that's it for today's video. If you found this video helpful, please like, share, and subscribe. And don't forget to share this video with your family and friends. Okay, thank you for watching. Thank you so much. We'll see you in next.